Hello and welcome to Portfolio Matters. In today's podcast, I will be reviewing the next batch of Share Talk summaries. So in previous podcasts, we have covered the top 20 most popular Share Talk companies and done a brief review and summary. And in this podcast, I will be covering the next 10, so 21 to 30. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, first up is Zinnwald Lithium, which has a lithium mine in Germany near the Czech border under development. And we covered the company on the 23rd of March 2020. And since then, the podcast has had 625 views. The share price at the time of publication was 15.5p, and it is now 16.5p, a return of 6.4%. And our original view was we were mildly positive. So this is the share price, and it has been a volatile ride. The share price shot up when they consolidated ownership of the mine by purchasing the 50% they didn't own from Deutsche Lithium, and it's now drifting off, which is despite an absolutely extraordinary rise in the lithium price. So this is the lithium price over the last year. A longer-term view puts everything in perspective. So the depths of the COVID disruption, lithium carbonate was trading at less than 50,000 yuan a ton, is now at almost 350,000. So more than a seven-fold increase in 18 months, an absolutely extraordinary rise, which is beginning to get noticed. I notice in the FT, amongst other things. John Dizzard was talking about this last week and saying how this was going to pose problems for battery makers. But the charts I've seen do not suggest there's actually much of a deficit at the moment. The deficit is really forecast to develop in later years, starting in around 2025, although the price of lithium would obviously seem to indicate that there is a shortage right now, but going forwards, that shortage would seem to get worse. A quick overview of the project, which is a lithium mine on the border with the Czech Republic, but it is still some years away from development. And compared to other lithium projects in Europe, the Zinnwald Lithium looks pretty good. We've got 100% ownership of the project, and it's 40 million tons and 0.76. So, looks all right. But the bottom line is, as of November 2021, we are still years away. So they're currently working on advancing the permit applications for the mining and mineral processing, and working at seeing if they can offer a wider range of lithium products, etc., etc. They haven't got the permits, and they haven't got full funding for the project as yet because they haven't got a mining plan. So on the mining life cycle chart, frankly, they are stuck in the value valley. And one of the big things we have learned doing this podcast over the past year is the difficulty of investing in early stage mining and oil exploration projects. Essentially, this chart works. So after the discovery, everyone gets very excited about discovering resource, but then it can take years and a lot of money to get it into development. And over that period, the share price tends to drift off. And sadly, I think Zinnwald is very much in this period here. So I think that a much better time to invest in Zinnwald would be when they finally start production, or at least when the mine is under construction and production is imminent. Before that, there are too many risks. And an illustration of that, so Rio Tinto this month had a lithium project in Serbia cancelled by the government following protests from the locals. So the project had been in development for years. Rio Tinto had got all the necessary permits to start the mine, but then there were mass protests and the Serbian government backed down and cancelled the mine. So even if Zinnwald managed to get all the permits, in Europe, people like the green transition, but they don't like the mining disruption, environmental damage that goes with extracting the metals and minerals necessary for the green transition. So until Zinnwald has actually got the mine in production, I fear there are too many risks for us to consider it as an investment. Hence, we're going to change our view from mildly positive originally to neutral and keep an eye on it. Okay, next up is the Australian rare earth mineral producer, Lynas Corp, that is one of the only companies outside China to actually produce rare earth elements. And we originally covered it on the 18th of February 2021. Podcast has since had 590 views, and share price has done very well over the period, up 51%. And we originally viewed it as speculative. Well, it's a speculation that would have paid off handsomely. This is the share price, which was doing incredibly well, although it's fallen off a bit in the last month. And Lynas has done well on the back of the rise in the neodymium price, which is used in modern magnets. So a big wind turbine, a 7 megawatt wind turbine, will use up to a ton of neodymium to provide the magnetic field in the generator. Now, neodymium and rare earth elements are going to be really needed for the green transition. But the problem is that green technology companies like Lynas are very in fashion, and there's a lot of ESG money chasing this sort of company. So Lynas is on a historic PE ratio of something like 42. In fact, Yahoo Finance having it at over 50. And when we originally covered Lynas, we discussed the market for rare earth elements and the fact that that market was likely to display very high price demand inelasticity, i.e., neodymium has relatively few industrial uses, therefore demand is quite fixed. So small changes in supply will lead to huge swings in the price of neodymium. And rare earth elements are not actually that rare. The problem is we just haven't been looking for them because there have been relatively few uses for them. Now the US has designated rare earth elements as strategic minerals, and there are a whole host of projects coming on around the world. In London alone, there are 3 rare earth mineral projects in development listed on the market. So going forward, our fears would be that there will be a flood of rare earth elements coming onto the market, and that will send the neodymium price right back down and Lynas's profits down with it. So in summary, Lynas right now is one of the few rare earth companies which actually has production. There are a lot of companies which have mines they are hoping to develop. Lynas is one of the few companies which can actually take advantage of the very high neodymium prices in the market at the moment. But once all those other projects come online, the danger is they drive the neodymium price right back down and Lynas's profits with it. So for a company with a P ratio of 42, it seems to us that all the risks are to the downside. So we are going to turn negative. Originally, we viewed it as speculative. Now we're negative. Okay, next up is Tekmar, the UK company which provides offshore services, in particular cable protection systems for offshore wind farms. And we covered it originally on the 13th of January 2021. The podcast has since had 582 views. The share price is down 20% since we did the podcast, and we were strongly positive, and we were wrong. And this is Portfolio Matters' big ESG investment idea, and frankly, it's not been great. So the fact that the shares are down 20% actually disguises the fact that they were down a lot more in October following a profits warning, when really this looked like a terrible idea and a terrible investment. And full disclosure, I own a decent chunk of this. Now, originally we were positive because of Tekmar's exposure to the offshore wind sector, and that is forecast to grow strongly in Europe, as you can see from this chart here, and also in China. And these charts are actually from Rystad Energy. So Tekmar, in theory, have good exposure to a growing market. These are the results of the latest Scottish government licensing round for offshore wind farms. And you'll see that there are a lot of companies pouring money into the sector. The Scottish government raised almost 700 million from these auctions. And you'll see a lot of these new wind farms are floating, and Tekmar is targeting the floating market as part of its growth strategy. Floating wind farms will require a lot more cabling. And if you look at the news section, well, they seem to be winning a few orders. Fingers crossed. But the problem with Tekmar is that it produces low margin products to a growing sector. And the big question is whether it can make a decent profit. It suffered from a great deal of COVID supply chain disruption, which destroyed margins and caused the profits warning. Essentially, they were getting a lot of their components from China, and when the supply chain disruptions hit, they were unable to source components, and then they had to have them made quickly in Italy at some cost, leading to margin erosion and the profits warning. So Tekmar, the jury is out. It is exposed to a growing sector, but we would like to see Tekmar demonstrate that it can grow revenues and make a decent profit. Last year, it lost money. A lot will depend on the 2021 results, which are reported on the 25th of February. So watch this space. But until that time, we are positive, and I continue to hold the shares. Okay, next up is Taseko Mines, the Canadian copper miner. Now, we've covered the shares back in August. The podcast has since had 581 views, and it is up a paltry 5.8% since then, and we were originally positive. This is the share price, which has been drifting off recently, and the copper price, which has been stable and high compared to history, though it hasn't been participating in the very strong bull market that most commodities have been experiencing. Copper is essential to the green transition and it's forecast to be in big deficit unless a lot of projects get commissioned, and that will require a lot of capital. Taseko Mines currently have an enormous open pit mine in Canada, which processes millions of tons of rock at around 0.25% copper. But the reason we were interested in Taseko was the Florence Copper Project, which is an in situ acid leaching project in Arizona. In situ acid leaching, as we covered in our original podcast, is much more efficient and lower cost. So this would have incredibly attractive economics, but it is behind schedule. So this is from an earlier presentation, and construction is meant to have started. Well, where we are now is that we are still awaiting the final permits for the underground injection and control. And construction can only start when that final permit is received. So in the meantime, Taseko is dependent on its huge Gibraltar mine in Canada, which processes millions of tons of ore at 0.25% copper, which is incredibly energy intensive. And as you'll be aware, the crude oil price has been going through the roof. So the energy costs for crushing and processing all that rock will be also rising, and therefore it's likely that Taseko's margins will be hit by rising oil prices. So we were originally positive on Taseko Mines. I now move that to short-term negative because I think that the rising oil prices will squeeze Taseko's margins for their open pit mine, but in the long term, once Florence comes online, then that should be transformative. And we'll look again at Taseko once all the permits for Florence have been granted and production has begun. In the meantime, I have halved my position. Okay, next up, number 25 is Serinus Energy, which is a small oil and gas company with assets in Tunisia and Romania, and we covered it on the 12th of March. And since then, the podcast has had 558 views, and we were then negative, which turned out to be right because the shares have almost halved. Now, you will remember that we covered Serinus and we went through its back history, and it had had a whole series of disasters, including a blowout at one of its first gas fields in Romania. And our conclusion was this was a collection of low quality assets in Romania and Tunisia. Well, that remains our view. And part of the reason the share price has halved is that its Sancrai 1 gas discovery in Romania turned out to be a failure. In July, it announced the discovery. In December, it announced that gas had failed to flow and the well had been suspended. And we know that the Tunisian assets are problematic and have had a long history of being marginal and difficult to produce from. So the bottom line is, I think there are just much better opportunities out there. You don't need to take the risk of investing in these low quality assets that are held by Serinus. But as always, there are no bad assets, there are only bad prices. So given that the price has now halved and Serinus are due to start work on the Tunisian fields, then perhaps it is worth taking a look. But for my part, I think there are other better assets out there and I will be avoiding. Okay, moving on to number 26, which is the UK listed downhole oil field technology company Hunting. And we covered that back in February last year, and the podcast has since had 541 views. And I was then strongly positive, and frankly, this is a big holding in my portfolio, and the share price has been very disappointing. Shares are down 14% since then, although you'll see from this chart, there was a period when the share price was down a lot more. But putting the share price, current share price, in perspective, the peak of the last cycle, the shares were above £8.80. And so there's still potentially a lot of upside if the company can return to its former levels of profitability. And a reminder, one of the reasons we really liked Hunting was that it's continued to invest in technology. The website is full of innovations that they are bringing to market, and they are always on the lookout for small add-on acquisitions. So this is one of their latest developments, a new highly automated detonation cord manufacturing facility in Texas, which can produce 900 kilometers of det cord per annum. And the reason that Hunting has been so disappointing is that revenues have failed to come through. So the company is barely profitable and is about break even in the past financial year. Part of the reason that there's been a failure of revenues to recover is that shale drillers have not really got back to work. They have been running down their stock of drilled uncompleted wells. And so the yellow line here is the DUC count, and you can see it's been coming down steadily. And as a result, the rig count has not been rising as quickly as it should, because shale drillers don't need to drill as many wells because they're just running down their stock of already drilled wells and they're completing them. But they can't keep on doing that forever. So they're going to have to get back to work. And as they get back to work, hopefully revenues for Hunting pick up. And this year, with the high oil prices, you hope to see a general lift in oil company capex, oil and gas company capex, because otherwise we're going to start running out of oil and gas more than we are already. And the elevated oil and gas prices show that the market is already concerned about supply. And this is the rig count, and you can see that despite the very high oil price, the rig count is not back to where it was pre-COVID. That has to change, and as that changes, hopefully Hunting's revenues recover. So in summary, I really like Hunting. It's a technology company that has continued to invest throughout the downturn. It has recently produced a joint venture with Jindal in India to produce oil country tubular goods there in a growing market. And it has bought the 40% share in Hunting Energy Services, which provides solutions for the European market that it didn't own, taking its holding in Hunting Energy Services UK to 100%. and it structured that deal in such a way that it actually sold the stock in the company to its former Japanese partners, and as a result, Hunting received $28 million from the restructuring, as well as gaining 100% ownership of those European operations. But above all, I think this is the year when CapEx returns to the industry and Hunting's revenues increase, and the shares remain towards their COVID lows. So I think there is plenty of upside, and I have been adding to my already substantial position recently. So we were originally strongly positive, and I am still strongly positive, and this is one of my highest conviction positions. Okay, next up is Diversified Energy, which has had a hell of a year. And a reminder, it specializes in acquiring late life gas fields in the US and then attempting to maximize the life of those old wells. And it aims to maximize cash flow from them and pay high dividends to shareholders. So it hedges a lot of its production. So we covered the company back on the 25th of January, 2021. Podcast has since had 514 views, and including dividends of 11.53p over that period, the shares are up 8.5%, and we were then strongly positive. But it has been a roller coaster ride. So in the second half of 2021, the shares were doing incredibly well until Bloomberg came out with a negative piece on it. Bloomberg had been round and looked at some of the old and frankly decaying and neglected wells within the Diversified Energy portfolio, and they'd taken a methane monitor with them and found lots of methane leaks. And as you'll know, methane is a very strong greenhouse gas, and that is very bad for the environment. And so this piece of investigative journalism was incredibly bad for the company and killed the share price. But Diversified Energy have reacted. They are going to increase the size of the team that is searching for methane leaks and fixing the problems, and it is going to accelerate the rate at which it closes down old wells, retires old wells. So it claims to do 100,000 site visits a month. So shares in Diversified Energy seem to trade at quite a large discount to fair value, given that the shares yield something like 12%. And part of that reason may be environmental concerns about the methane links, but also there are worries that essentially DEC is not fully accounting for the cost of retiring old wells, although they insist that is the case. So in summary, I remain positive about Diversified Energy. It is continuing to grow its portfolio of assets and has done a number of deals in the last year in which it's added further acreage in the Haynesville and Barnett shales and now has essentially a second hub there. Although, of course, it has to keep on adding assets to offset natural declines. But as long as the shale industry continues to drill wells, there will always be portfolios of old wells available. And the shares are really cheap. So not only does it pay a dividend of 12.2% and growing, but it's on a P ratio of 5.4 and with earnings growing at 19.8% a year. So it is a cheap growth company. So on fundamentals, this looks like a great investment. The only problem is the environmental concerns and the concerns about whether it is in fact just doing some financial engineering and not fully accounting for the costs of retiring all the old wealth, which is one of the points in the original Bloomberg article. Now, Simon W. on our Discord channel was saying that the well abandonment costs would be much less of a concern for US investors than it is for UK investors. And the company is looking at doing a dual listing, and US investors could then buy in and they would rate the company more highly. So that is also another potential catalyst. Although it hedges the majority of its gas production, obviously gas prices are rising, and as it re-hedges, it will re-hedge at higher prices. So that is also positive. So in our original view, we were strongly positive, and I remain strongly positive. Right, next up is the Latin American gold and silver miner, Hochschild Mining. Now, we covered it back in January last year. Podcasts had 478 views, and sadly, we were positive, but the share price has since halved. And a quick reminder that this is a big gold miner, which last year produced 9.8 million ounces of silver and 175,000 ounces of gold. But 2/3 of its production comes from Peru. And this is the share price. Now, I sold the shares back in May when I sold the vast majority of my gold miners because I thought that interest rates were going to rise and that would be bad for the gold price. And that has been a good decision. This is the silver price, which has gone nowhere. The reason that was a good decision was actually nothing to do with gold and silver or the fundamentals of the company. It was the fact that Peru elected a socialist president who in November announced that he was going to refuse the permits for several mines in Peru that had been subject to protests from the locals over environmental concerns. And 2 of those mines were the Hochschild mines. So when that was announced, there was a sharp fall in the share price of Hochschild, but then 2 days later, the president appeared to reverse his earlier decision, and he made some emollient noises. But it's not really clear what he intends to do. In order to keep production, Hochschild really needs these extension permits, and it's 2 mines. If it doesn't get them, it's going to have to close down. And the locals are protesting against the mines on the basis that they pollute local water supplies. So a lot depends on whether the government grants those permits. If it doesn't, and Hochschild has to close its mines, that's 2/3 of its production gone. Without those permits, Hochschild would have to close Immaculada by the end of 2023. When we originally covered Hochschild, we commented on the fact that we didn't know of any other company that had been so badly affected by COVID, and they had closed a lot of their production due to COVID and trying to protect local communities. But the last year production bounced right back, which was very good for EBITDA, as you can see, which more than doubled. revenue increased by 70%, and the gross margin increased from 26 to 43%, all of which is very good. They also divested of their Biolatinidos rare earths project by listing it in Canada. And in listing it, they raised money to actually start work there while retaining 20% of the company. That is positive news. It accelerates the development of the project, and Hochschild retained 20%. But in summary, Hochschild are hostage to the Peruvian government. The Peruvian government have told the locals one thing and the mining companies another thing. And in 2022, they're going to have to make a decision. If that decision is to decline the permits for the extensions at Inmaculados, then the mine will have to close down in 2023. And that would be incredibly bad for Hochschild. So I think this is uninvestable until the government has made up its minds. So we were then positive. I now think negative. I think this is uninvestable. Next up is Ares Strategic, which has a fluorspar development project in Utah. Now, we covered it in June last year, and the podcast has since had 465 views. And since then, the shares are down 18%, despite us being strongly positive. And frankly, this is a problem child. So you'll see that actually the shares have ticked up recently. But for a long time, the shares were really languishing. And despite the economics of this project looking great, the share price was down over 50%. And a reminder, fluorspar is used in a lot of industrial processes, has been designated by the US Department of the Interior as a critically important mineral. And as a result, the USDA has partly funded Ares Strategic to develop its fluorspar mines to the tune of 13 million, all of which is great. But the share price drifted off because of delays. Essentially, supply chain disruptions all around the world meant that they had trouble getting hold of the steel for the fabrication of the fluorspar lumps plant, which has been delayed. It was due to be actually constructed by the end of last year, but the steel was only shipped to the US in January, and construction will now begin. And if you listen to interviews with the CEO, he was saying the original supplier said the steel price had gone up threefold. They had to do some fast work to avoid very serious price rises in the project. While all that was going on, they did a survey of their lands, and they increased the acreage of the Lost Sheep fluorspar project to 6,000 acres and have identified 160 potential drill sites. So they have a lot of areas they could potentially exploit. Now, fluorspar is not widely traded, so it's quite difficult to track down exactly what prices have done. And I haven't got a chart, but the few stories I could find on the web indicate that the fluorspar price is currently doing all right, which would be good news. But one of the reasons that Ares Strategic has been a frustrating investment for me is that it delisted from the Toronto Venture Exchange, where I bought my shares, and it was then going to list on the Canadian Securities Exchange. But then on the 30th of July, it announced it couldn't list on the Canadian Securities Exchange without filling out some new forms. And so it didn't list there until the 22nd of October. So if you held shares, as I did, you couldn't really trade them over that period without converting them into ADRs to trade in the US, I believe. And I now find myself trapped because my broker, Interactive Broker, refuses to allow you to buy any shares listed on the Canadian Securities Exchange unless they have a market cap in excess of $400 million, which Ares Strategic doesn't. So, although the share price had collapsed and I wanted to buy more, I couldn't. And actually, I won't be able to buy more. I will only be able to sell. So I intend to hold on to my position in Ares Strategic for years, potentially. And Ares Strategic is another great example of the mining life cycle chart, because essentially what's happened is we remain in the value valley. The mine continues to be in the pre-development stage until we get the construction going, which it should be imminent, but has been delayed because of, in part, the global supply chain disruptions. In summary, I still like this, but you have to find a way of buying the shares, frankly. When we went through the economics looked incredibly good. And since then, Ares Strategic have actually expanded their acreage and have identified a lot of fluorspar targets. But it illustrates once again dangers in investing in these pre-production mining projects, in that the mine has taken a lot longer to bring into production than was forecast last year. It was then forecast to be in production by the end of last year, and the construction of the lumps plant is only beginning now. So we were then strongly positive, and I move us to neutral until the mine actually starts production. And that will be the new policy generally. We're not going to cover any companies until they actually start production. And finally, Anglo-Asian Mining, which has gold, silver, and copper mines in Azerbaijan. Now, we originally covered it in February last year. Share price was then 155p, and the share price has fallen by almost 30% since then. And the podcast had 451 views. Our original view was speculative. I sold my shares earlier in the year when one of our Discord members, Ali Baroid, pointed out that we were assuming that the war between Azerbaijan and Armenia was over, whereas he was hearing that Armenia was searching the world for drones with which to restart the war. You will remember that Azerbaijan managed to reconquer a lot of its territory previously held by Armenia with the help of Turkish drones. And Armenia is now attempting to regain parity in military technology, at which point the danger is they try and restart the war. And at that point, I thought that discretion is the better part of valor, and I didn't want to hold these shares. So I made a loss on my shareholding, but selling has proved to be the right decision. Anglo-Asian have actually had a very busy period. They have acquired 2 new contract areas from the Azerbaijan government, one of which contains a copper porphyry. Now, if you watch our share talk on Phoenix Copper, we go into how copper porphyry is formed. And essentially, copper porphyries contain huge resource, huge tonnages of low-grade copper. And some of the largest copper mines in the world are porphyries. So that is potentially exciting. But in our original podcast, we were too optimistic about the timescales and the potential for the company to regain access to the areas that were formerly under Armenian control, which the Azerbaijan government had restored to the company. And in particular, we were then excited about the Zod mine, which is the largest gold mine in the Caucasus, which had been restored to the company as part of the Sutli contract area. Well, unfortunately, the company have given up attempting to access that mine and have relinquished that contract area. So these are its contract areas at the end of this year. And the Vesnali area, it has recently gained access to and has a gold mine there that is hoping to bring back into production late this year. And it also has been working on the Zafar mine, which it hopes to bring into production in 2023. And that is a big copper mine. And this is the new contract areas, which have actually decent copper grades for a porphyry, 0.65%. So that is potentially very exciting. This is the Vesnali formerly occupied area, which as of December, the company had been granted access to and are currently doing a technical study on restarting production from the gold mine there. So in summary, I think Anglo-Asian is incredibly well run, and they have some interesting and exciting development prospects, but there's huge geopolitical risk. And we were too optimistic about the prospects for regaining access to the contract areas that they had regained from Armenian control. And in particular, they haven't basically got control of the Zod mine and have now given up and relinquished the Sutli contract area. But the share's good value, they yield 6.5%, and the company has net cash of 37.5 million. So good value with good growth prospects. But, you know, is the war really over? That is the reason I sold my shares, and it's not really a risk I wanted to take. So our view then was that it was speculative, and I think it's still speculative. And I will not be buying the shares currently, particularly given the tensions with Russia over Ukraine. So that's it. That is the second to last batch of Share Talk updates. I hope you enjoyed that. Please can you press like and subscribe to the channel. And in the meantime, it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.